Silver has shattered everything we thought we knew about precious metals markets. And I'm not talking about a routine price spike here. I am talking about a complete system failure that is unfolding right now in real time while central banks and exchanges scramble to contain something they can no longer control. Shanghai just pulled the emergency brake. Over the weekend, they hiked margins to unprecedented levels. This move is a cry of pure panic, and you know what? It is not going to work. In fact, it is probably going to make things worse. Over the next 15 minutes, I'm going to show you exactly why this desperate attempt to slam the brakes on silver proves that the market is fundamentally broken, and why what comes next could reshape the entire precious metals landscape. I am not a financial advisor. This is not financial advice, and I am not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Let us start with the numbers that nobody can ignore anymore. Silver has absolutely demolished its 40-year all-time high. We are currently trading in a range between $61 and $64 per ounce. On December 12th, silver touched an intraday high of $64.65, marking a new historical record. To put that in perspective, the previous all-time high was set back in 1980 at around $49. That record stood for 45 years. 45 years, and now it is gone, completely obliterated. Since the beginning of 2025, silver has surged over 115%. That is not a bull market. That is a moonshot. That is the kind of move you see when fundamental market structures are breaking down. Gold has had an incredible run too, up about 60% year to date. But silver is leaving everything in the dust. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has collapsed from over 90 to around 67. That is a massive revaluation of silver relative to gold, and it is telling us something crucial about what is really happening in these markets. However, the point most people are missing is this. The real story is not the price explosion. It is the desperate official actions being taken behind the scenes. That is where you need to pay attention. That is where the truth lives. And that brings us to what I'm calling the Shanghai signal, one of the clearest signs of institutional panic we have seen in modern commodity markets. Picture this. It is Friday evening. The markets are closed for the weekend. Everything is supposed to be quiet. Traders are wrapping up their week, looking forward to some downtime, and that is when the Shanghai Futures Exchange drops a bombshell. They jacked up margin requirements on their main silver futures contract to 17% for speculators. Now, if you are not deep in the futures world, let me explain why this is such a massive deal. In futures trading, margin is essentially a security deposit. It is the cash you have to put up front to prove you can handle any losses on your position. When exchanges raise margins, they are making it exponentially more expensive to hold positions in that market. They are trying to cool things down, to reduce leverage, to force traders to put more skin in the game. The context you need is this. Normal margin requirements for most commodities typically hang out somewhere between 5 and 10%. That is standard operating procedure, but the Shanghai Futures Exchange was already at 16% before this latest hike. 16% is already extraordinarily high. It is a level that tells you the exchange is deeply concerned about volatility and counterparty risk. And yet, even at 16%, they looked at the market conditions and decided they needed to go higher. They pushed it to 17% in an emergency weekend announcement. Let me be crystal clear about what this means. Exchanges only move this fast and this aggressively after markets close when they are genuinely terrified, when they believe the market is about to spiral completely out of their control. This was not a carefully planned strategic adjustment announced weeks in advance. This was a panic move. They saw the price action accelerating. They saw delivery requests piling up. They saw physical demand overwhelming paper supply, and they realized they were staring straight into an abyss. Now, you might be wondering why Shanghai matters so much. Why should we care more about what happens on the Shanghai Futures Exchange than what happens on the COMEX in New York? This question is absolutely key to understanding everything that is unfolding right now. It all comes down to what these two exchanges really represent. Think of it this way. The COMEX in New York is the paper market. It is the casino. It is all about speculation, leverage, and paper bets on the price of silver. Traders can buy and sell massive quantities of silver contracts with no intention of ever taking physical delivery. It is a price discovery mechanism, sure, but it is fundamentally detached from physical reality. The vast majority of contracts are settled in cash, not metal. The Shanghai Futures Exchange is the complete opposite. It is the physical market. It is the factory floor where real companies go to secure real metal to build real products. Chinese manufacturers need actual silver for their production lines. They cannot run their solar panel factories or electric vehicle plants on paper promises. They need the physical metal, and they need it now. And here's the thing about China's appetite for silver. It is absolutely massive. China is the undisputed heavyweight champion of silver consumption globally. They are the number one user of silver for solar panels, which are being deployed at a staggering pace. Over 200 gigawatts of solar capacity are planned for 2025 alone. That translates to thousands of tons of silver. They are also ramping up electric vehicle production, where each vehicle uses significantly more silver than traditional cars. We are talking about 25 to 50 grams per electric vehicle compared to around 5 grams for a conventional vehicle. And when you are producing millions of vehicles, those grams add up fast. For most of these critical high-tech applications, there is no viable substitute for silver. You cannot swap it out for copper or aluminum and get the same performance. Silver has the highest electrical conductivity of any metal. It is essential. It is irreplaceable. And Chinese industry knows this better than anyone because they are the ones actually manufacturing these products at scale. So when the primary exchange, serving the world's biggest physical buyer, has to slam on the emergency brakes because the market is overheating, that is not a local problem. That is a global red alert. Let us talk about what Shanghai is trying to accomplish with this margin hike. The playbook is pretty straightforward. By making it incredibly expensive to hold long positions betting that the price will go up, they are trying to force traders to sell their contracts. The theory is simple. If you flood the market with paper supply by forcing people to liquidate their positions, you can crash the price back down and bring the market back to heel. This is a classic paper market manipulation tactic that has been used countless times over the decades. And sure enough, experienced market watchers saw it coming immediately. Within minutes of the announcement hitting social media, warnings flooded trading communities. Brace for brutal market opens, expect volatility. This is a shakeout move. Everyone who has been through these cycles recognized exactly what was happening. The Borsa was trying to engineer a violent price smash to scare traders out of their positions. But here's the fundamental problem they are facing, and this is why I'm telling you this margin hike is doomed to fail. You can manipulate paper prices all you want, you can change margin requirements, you can implement circuit breakers, you can halt trading if things get too crazy. But there is one thing you absolutely cannot do. You cannot print physical silver bars. And that is the criz at the core of this entire situation. Chinese factories need silver, not want, need. Their production lines do not stop because some bureaucrat at an exchange raised margin requirements. Solar panel manufacturers have contracts to fulfill. Electric vehicle makers have production targets to hit. Electronics companies have components to build. The industrial demand is real, it is urgent, and it is not going away just because paper traders are getting squeezed. This is the paper versus physical disconnect that silver analysts have been warning about for years. As long as price discovery happened primarily in paper markets, the physical reality of limited supply and explosive demand could be suppressed. But we are reaching the point where that suppression mechanism is breaking down. More and more market participants are saying, forget the paper games, just give me the actual metal. And exchanges are panicking because their warehouses do not have enough to deliver. Let me give you some context on just how tight physical markets have become. According to the Silver Institute, the global silver market is forecast to be in deficit for the 5th consecutive year in 2025. We are talking about a projected shortfall of around 117 million ounces. That is over 3,600 metric tons of silver that the market needs but cannot produce. Mine production has essentially flatlined at around 813 million ounces annually, while demand keeps climbing. Industrial fabrication reached a record 680,5 million ounces in 2024, up 11% from the previous year. And projections show that industrial demand will surpass 700 million ounces for the first time in 2025. The solar sector alone is expected to consume 261 million ounces this year. Electric vehicles are projected to add another 90 million ounces. And we haven't even talked about the traditional uses in electronics, medical devices, and other industrial applications. This is why Shanghai's margin hike fundamentally cannot work. The paper market can try all the tricks at once, but you cannot suppress physical demand with paper mechanisms when users actually need the metal. And here's the kicker. Every time exchanges pull moves like this, every time they try to engineer price smashes through margin manipulation, they actually make the underlying problem worse. Because what happens? Physical elistlers see the paper price getting hammered, and they step in to lock in what they perceive as bargain prices. Industrial users who are planning to buy silver next month say, you know what? If the exchange is going to give us a discount through this manipulation, we will accelerate our purchases. Investors who understand the physical fundamentals see paper price weakness as a buying opportunity. So instead of relieving pressure on the physical market, these paper market interventions often trigger even more aggressive physical buying. It is a vicious cycle that ultimately accelerates the breakdown of the entire system. Let me walk you through what I think happens next, because this situation is far from over. In the short term, over the next few days and weeks, expect serious volatility. Shanghai's margin hike is just the opening salvo. If the price continues to run, we will likely see more margin hikes from exchanges around the world. We might see circuit breakers triggered or trading halts. They are going to throw every tool in their arsenal at the situation to try and regain control. But here is what you need to understand. Every one of those interventions is an admission of weakness. Every emergency measure they take is them telling the market, we have lost control and we are desperately trying to get it back. And smart money recognizes that. In the medium term, I expect to see physical premiums continue to rise. The gap between paper prices on exchanges and the actual price you pay for physical metal in hand is going to widen. We are already seeing this in some markets. Dealers are reporting that getting physical silver at anywhere near spot price is becoming increasingly difficult. We may also see more exchanges face delivery problems. If participants start standing for delivery in large numbers, demanding physical metal instead of cash settlement, exchanges could find themselves in a serious squeeze. Remember, most futures trading is leveraged speculation with no intention of taking delivery. But if that changes, if a meaningful percentage of contract holders demand the actual metal, the system breaks down fast because there simply is not enough physical inventory to back all the paper claims. Long term, if current trends continue and industrial demand keeps accelerating while supply remains constrained, we could see silver prices that seem impossible today. Analysts have thrown out targets of $75, $100, even higher. When you have persistent multi-year deficits, basic economics says the price has to rise until either demand is destroyed or new supply is incentivized. The critical question nobody can answer with certainty is, how high can silver go when the world's factories are competing against investors and industrial users and stackers for a limited supply that cannot be printed? We have broken through the 45-year high. We are in completely uncharted territory now. And Shanghai's panic tells us they are terrified to find out the answer. The bottom line is this: The silver market is breaking. Shanghai's desperate margin hike proves it beyond any reasonable doubt. Their attempts to stop this with paper market tricks won't work because you can't print physical metal. The industrial demand is real and relentless, the supply deficit is structural and multi-year, and the disconnect between paper markets and physical reality is reaching a breaking point. This is not financial advice. I'm just showing you what is happening behind the curtain. But understand this. We are witnessing something historic. The repricing of silver is not coming. It is already here. Despite their best efforts, the authorities can't stop it. The physical reality of limited supply and explosive demand is finally overwhelming decades of paper market suppression. And that's why Shanghai is panicking. You can't fight physics with paper. Right now, the physics of supply and demand are absolutely crushing the paper markets. Stay informed. Watch what happens next. The story is far from over.